This is Nightly Business Report with Tyler Matheson and Susie Garrett. Funded in part by
TheStreet.com and Action Alerts Plus, where Jim Cramer and fellow portfolio manager Stephanie Link share their investment strategies, stock picks, and market insights. You can learn more at TheStreet.com/NBR.
Stocks rock. The decline's sharp and severe. The Dow Jones Industrial Average falls more than 260 points as cratering crude rattles investors.
The fast and furious selling in the oil market sent prices close to $60 a barrel, their lowest levels since mid-2009.
Tonight, two experts tell us whether there's more selling ahead and the best ways for investors like you to ride out the volatility. All that and more tonight on Nightly Business Report for Wednesday, December 10th.
Good evening, everyone. We begin tonight with two big sell-offs, a massive pullback in stocks, which followed another sharp drop in the price of oil after reports showing U.S. energy stockpiles grew while global energy demand forecasts shrank. It was a nasty day on Wall Street. Stocks tumbled, with the sell-off accelerating right into the close. The Dow fell 268 points. The Nasdaq lost 82 points, its biggest one-day drop in 2 months. And the S&P was down 33 points, with all 10 sectors ending lower. Over in the oil markets, NYMEX crude fell another $2.88. That's a 4.5% drop, ending just below $61 a barrel, the lowest level since July of 2009. International Brent crude lost $2.60, closing at $64.24. We have two reports looking at today's sell-offs. Bob Pisani wraps up the market action at the New York Stock Exchange. But first, here's Jackie DeAngelis on what's behind the latest drop in oil.
Oil prices in free fall. Traders who had called the bottom now ducking for cover. The reason behind today's plunge? Outlook revisions for next year. OPEC revising down its demand forecast while its production remains at over 30 million barrels a day. The Energy Information Administration trimming its output forecast, but only by 100,000 barrels. Over 9 million barrels a day is still very robust. Add to that weekly inventory data from the Department of Energy that showed another 1.5 million barrel build in supply, and prices tanked more than 4.5% to $60.94. So how low can oil go before the end of the year? Many traders see the 50s in the market's future.
This market seems to be getting one bearish news item after another as we trade lower even. So brokers on the floor and traders on the floor, we're looking at $50 now as the bottom for crude oil, and we expect that to happen in early January, and that's a revision down from where we thought prices were going to go just a couple of months ago.
And add insult to injury, Goodrich Petroleum saying it may have to sell some of its shale assets to boost liquidity. Analysts saying that other companies are going to have to follow suit to strengthen their balance sheets. What this tells the market is that small producers are worried. A slew of companies, including Goodrich, lowering capital spending budgets for 2015. Investment in drilling and exploration projects just don't seem to make sense in this environment. While cheap oil helps companies and consumers keep their costs low, it's going to hit the oil patch where it hurts. For Nightly Business Report, I'm Jackie DeAngelis.
The stock market again proved very sensitive to two issues: the decline in oil and slower global growth concerns. There were new 52-week lows all over the energy space today, including big names like Chevron, the drillers like Transocean, exploration and production names like Noble, all of them down about 3 or 4%. Now, there is plenty of collateral damage from lower oil. Canadian bank stocks like Royal Bank of Canada or Bank of Nova Scotia, both involved in financing Canadian energy plays, were all down about 3%. Commodity countries are also getting hit on the lower growth concerns. So exchange-traded funds associated with Russia and South Africa and Canada, they were all down 2 or 3%. Not surprisingly, other commodity stocks also appeared on the 52-week low list, including iron ore names like BHP Billiton and Vale, as well as copper giant Freeport-McMoRan. Slower growth in China and a crackdown on high rollers in Macau has dropped Las Vegas Sands and Wynn, both big in the China gaming market, to new lows as well. Now, will these declines continue? Well, oil is lower mostly on supply issues, not dramatically lower demand. Slower global growth is definitely an issue, but many stock markets outside the U.S. already reflect that slower growth. Now, with all these concerns, it's hard to argue that lower oil is bad for stocks or the U.S. economy. The S&P remains close to its historic highs, even with the energy sector down 15%. and even while oil is down 40% this year. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
All right, let's turn now to our oil and market experts for more analysis and context. Russ Kostrich is Global Chief Investment Strategist at BlackRock, and Eric Wiegand is Senior Portfolio Manager for U.S. Bank's Private Client Reserve. Gentlemen, welcome. Russ, let me begin with you. How much farther do you think this sell-off might have to go?
I think we can certainly see more volatility, primarily because we've had such a big move over the last 6 weeks. You think about the move in the S&P 500, we're up about 14%. We were up 14% up until the last couple of days. That was a very big move in a short time. The VIX index got back down to about 11. So there was a lot of complacency, a lot of good news in the market. I don't think this is all about oil. And to the extent that we see more issues in Europe, more evidence of slower growth, it's completely possible there's more selling to be done. But generally, I think the fundamentals of the market are, for the most part, sound.
Eric, let me ask you about oil prices. I mean, why should lower oil prices be bad for the stock market? Presumably, if you have less energy costs, this should be good for company stocks going forward and their earnings. What do you think?
You know, we would agree, particularly with regard to cost coming in and a benefit to the consumer. However, the concern does turn to capital expenditures, particularly throughout the oil patch, and more importantly, getting a grasp on what the overall growth outlook is for global markets.
Russ, let me turn back to you and let's talk a little bit about the global economy, if we might. I was speaking earlier today with an investor and skilled market watcher who pointed out that if we paid nearly as much attention to what's been happening in commodities, including but not limited to oil, commodities like copper, like iron ore, and many, many others, including agriculture, we would be in really a kind of silent crash. Does that tell you that we're sort of, here in the United States, whistling past the graveyard as the rest of the world slows very dramatically?
Well, this has been a trend we've seen throughout the year, and I think it's likely to continue in 2015. Now, you raise an important question. Can the U.S. continue to grow if the rest of the world is slowing down or even contracting? I think for the time being, the answer is yes, because in the U.S. you have a very strong domestic economy, makes about 70% of overall economic activity. The consumers we mentioned will benefit from cheaper oil. We're seeing further improvements in the U.S. labor market, but it doesn't mean the rest of the world won't affect U.S. markets. It already is, to the extent that slow growth in the rest of the world, low bond yields in Europe, low bond yields in Japan, are one of the reasons that the U.S. 10-year Treasury is at 220, following the best 2 economic quarters since 2003. So I don't think it pulls down the U.S. economy to recession, but it does affect our financial markets.
Eric, is it a gamble to get into energy stocks now because the prices have come way down? And if you say it is okay, can you give us some kind of inkling about which areas to invest in?
You know, we certainly believe that the volatility is likely to remain until some of these issues are addressed. Number one that has to be addressed is resetting of expectations. We've seen analysts taking their earnings estimates down rather aggressively. Perhaps that needs to come down more. And also a resetting of expectations as far as base growth, removing some of that capacity, particularly some of the levered players from the space. We do think that we are approaching a more appropriate opportunity for investors to consider entry here, but we've maintained a position of being underweight the space relative to the S&P.
When the moment comes, Eric, to go overweight the space, is the best way for individual investors to play it through an ETF? And if so, what kind of ETF in energy? Because they're differentiatable.
They really are. And while we're talking about the energy space as being rather homogenized, it isn't. There's a lot of differentiation between certainly the major integrateds, the exploration and production folks, as well as the service side. And we expect to see a rather meaningful amount of shakeout and differentiation between the quality and the group. I think investors really have to come back and reassess what their investment objective is, what their risk tolerance, and certainly their investment horizon.
Russ, there are 14 trading days left to this year. Give us a real short-term forecast. What happens with stocks between now and then?
I think we're going to see more volatility. It doesn't mean the S&P won't put on a few points between now and then, but I think it's a little bit of a precursor of 2015. We're ending this period of unusually low volatility. We're getting closer to the point when the Fed starts to hike rates. Part of this is normal. We're going back into a regime of more normal volatility. Doesn't mean stocks won't go up, but it's likely to be a bumpier ride for the rest of the year and in 15.
Russ, I just hope that the S&P puts on more points than I do pounds between now and the end of the year. Russ Kostrich with BlackRock and Eric Wiegand of U.S. Bank's Private Client Reserve.
Well, the steep fall in oil prices is prompting British oil giant BP to slash thousands of jobs by the end of next year in a $1 billion restructuring plan. The company says cuts will come from all segments, including exploration, production, refining, and trading. Some capital spending will also be scaled back to save money.
Well, those tumbling oil prices also, of course, mean that prices at the pump are down. Just today, AAA reports a gallon of regular gas, $2.64 a gallon on average nationwide. That's 11 cents lower than just a week ago. The Energy Department says gas could fall even further to an average of $2.60 a gallon by 2015.
Drivers aren't the only ones benefiting. Airlines are seeing their profits soar thanks to that drop in energy prices, along with more ticket buyers and more and higher fees and greater efficiency. The International Air Transport Association, which represents 240 carriers around the globe, is predicting a record profit of $20 billion for the airlines this year and up to $25 billion in 2015.
And still ahead, why one of the hottest startups of the year, the ride-sharing company Uber, is hitting roadblocks all across the globe. A big setback to U.S. prosecutors in New York looking to clean up Wall Street. A federal appeals court overturned the convictions of two former hedge fund managers on insider trading charges. The two traders, who work for different Connecticut-based firms, were found guilty in 2012 of trading and benefiting from inside information about tech firms Dell and NVIDIA. But today, a higher court, an appeals court, ruled that both convictions should be vacated because the government basically failed to present sufficient evidence of insider trading or showed that they conspired to break the law.
Some good news for Washington bean counters. The federal budget deficit narrowed a lot more than expected in November. The government still spent nearly $57 billion more than it took in last month, but that was $15 billion less than forecast. Higher tax revenues this year getting a lot of the credit.
Also in the nation's capital, Congress did approve a massive $1 trillion funding bill that will keep the federal government up and running past tomorrow's deadline. But it is not a done deal just yet, despite what you might have read this morning. John Harwood joins us now from Washington. John, there's been a lot of complaining today about provisions in the massive deal. What are the complaints about?
There's several provisions that have become controversial very late in the process, Tyler. One of them has to do with green-lighting certain cuts to multi-employer pension plans. It's divided unions, divided liberal Democrats. Some are in favor of it, some aren't. You've got a question about campaign finance and a provision that allows large donors to donate more money to political parties for the purpose of putting on their conventions. And finally, there's a challenge to the Dodd-Frank Wall Street regulation law and a provision, again, that had been negotiated by Democrats and Republicans. So it's not all or nothing on both sides here, but a provision that would allow banks to shield more of their some of the allegedly controversial trades, swaps, in the insured side of their business. That is the part of it that's insured by the FDIC. All of those things have become controversial. Elizabeth Warren on the left has come out against the plan, and you've got Democrats in the House who are raising objections. Not clear how serious those objections ultimately will prove.
You know, John, this is so puzzling and frustrating because the deal was negotiated between a Republican House, a Democratic Senate. So why are we getting these last-minute controversial debates?
In addition to that, Susie, negotiated with the assistance of the White House. But what happens is when you've got people, staff, and members of Congress, White House staff, behind closed doors who are making a deal that they think can hold together, sometimes when it gets put out in the light of day, you get members, especially the more ideological members on left or right, coming out and saying, hey, wait a minute, I can't live with that. And then you've got a crisis. That's the classic way that Washington gets itself in a ditch. And I think we will still avoid a government shutdown. But right now, it is unclear exactly where the votes are for this package tomorrow.
So chances are we avoid a government shutdown very quickly. Do we get a bill that carries us through the rest of the fiscal year, or could it be a very quick stopgap measure?
There could be a stopgap measure to give the Senate more time to work this out, but Senate aides tell me if the House passes this, the Senate will pass it promptly, and the only question is whether those votes from both Democrats and Republicans will be there in the House.
All right, John Harwood in Washington, thanks.
Back to the markets now, where home builder stocks got little help from two big-name companies after reporting solid, mostly in-line quarterly earnings. Shares of Toll Brothers tumbled about 8%, reflecting how most of the big builders fared today. Hovnanian shares, though, were up more than 5%, despite the CEOs of both companies having some less than complimentary comments about their business this past year. Diana Olick has more.
The nation's home builders aren't exactly raving about the year that was in housing. Uneven, choppy, disappointing, slow. Just some of the words the CEOs of Toll Brothers and Hovnanian used with analysts on earnings calls today. When asked if tight credit was still a big culprit, Ara Hovnanian replied, undoubtedly.
The mortgage industry, including our own mortgage company, are just being much tougher on underwriting. They've been overly cautious.
That may be why so much of the sales activity now is on the high end among wealthier buyers. Hovnanian's average price went up, but not for the reasons the builder might like.
I'd like to say that we raised home prices, but this increase in average sales price is primarily due to geographic and product mix changes.
Luxury home builder Toll Brothers missed on earnings slightly, but its average home price also rose, again, not because the builder raised prices, but because it sold more expensive homes. CEO Doug Yearley does not expect that to change anytime soon.
The house we sell today is going to struggle to be marginally accretive when it delivers 9 months from now, because we just don't have the pricing power to improve the margin.
Both builders agree on something else, that while 2014 sales were flat from last year, there should be more growth next year. That is based on real fundamentals.
6 months ago, we were looking at dislocation in the job market. We've had really robust job growth, and interest rates are still very attractive from a borrower's perspective. So we actually expect to see a lot of momentum going into 2015.
So what was a toxic cocktail of higher home prices, weak employment, and tight credit in 2014 is now changing to a smoother mix of easing home prices, low interest rates, and loosening credit. The one wild card in this drink, as always, demand. For Nightly Business Report, I'm Diana Olick in Washington.
McDonald's is slimming down its menu, and that is where we begin tonight's market focus. The burger chain is cutting its offerings in an effort to speed up service and increase sales, also considering getting rid of some of the ingredients it uses to change perceptions about its food. This comes as the company has struggled recently to turn around its performance because of, in part, increased competition. Shares off 1.5% today to $90. Costco's quarterly profit topped estimates as increased promotions helped the company deal with fierce competition. The wholesale club operator's revenue was in line. Same-store sales were higher. Still, shares were off about 2%, 140.25 the close. And two updates on treatments that Merck is working on. In an early-stage trial, its drug shrank tumors in some breast cancer patients. Also, a new version of the company's HPV vaccine called Gardasil has been approved by the Food and Drug Administration to provide broader protection against cancers. Shares were off just a few cents today at $59.98.
Land's End saw its sales fall in October as its store base dwindled, but a better assortment of merchandise and a targeted promotional strategy helped drive a big increase in earnings. Even so, investors focused on that drop in revenue. Shares down more than 7% to $46.95. And a transit agency is suing Gilead Sciences for the pricing of its hepatitis C drug called Sovaldi. The company sells the highly effective medication for about $1,000 a pill, but it costs less to buy the treatment in other countries. The suit claims the drug maker's pricing is an abuse of its patent monopoly on the drug. The stock fell 1% to $104.84.
Well, calling a car service or hailing a taxi may be a thing of the past for many people. With the emergence of Uber, the smartphone-based app that teams up people in search of a ride with Uber-approved car owners willing to drive them for a fee. But as Uber rapidly grows, the ride-sharing service is running into a lot of roadblocks. Kate Rogers has more.
Uber, the disruptive transportation app that allows users to hail a ride on demand, has quickly garnered both criticism and praise across the globe since its launch in 2010. Users love the ease and convenience it provides them via ride-sharing. But it's also notoriously clashed with transportation establishment in big cities like New York and London for taking both customers and drivers away from them. The startup's massive valuation, which just last week hit an eye-popping $40 billion, has also been a hot topic over the past year as it's continued to balloon. This week, the company's facing new challenges from the U.S. to India. Yesterday, the San Francisco and Los Angeles County District Attorneys filed consumer protection suits against Uber for making false or misleading statements to consumers and engaging in business practices that violate state law. Uber said in a statement it's met with both offices and will continue to engage in discussions with the district attorneys in the Golden State. Portland has also sued Uber to stop operating within the city, where it just launched on Friday, claiming the company isn't following local regulations. And over the weekend, an Uber driver in India was arrested on suspicion he raped a passenger in New Delhi. The Indian government has since requested state governments ban Uber and other non-registered web-based taxi companies like it from operating. India is one of Uber's largest markets outside of the U.S. It remains to be seen what this means for the company's valuation, IPO potential, and investor perception. But Aswath Damodaran, professor at NYU's Stern School of Business, says the company's message remains consistent, which benefits it greatly.
Uber's story has always been, this is a big market, it's run inefficiently, and we have a much better way of doing things than the existing players do.
He adds that even bad press can still be good for a young growth company.
In a strange way, you can't have bad publicity when you're a company like this because you want your name up front.
Despite the setbacks this week, Damodaran says the upstart still has a lot of potential for growth. For Nightly Business Report, I'm Kate Rogers.
Coming up on the program, Youngstown, Ohio, a steel powerhouse that fell on hard times. But can the new energy boom help revitalize the city's economy? The second part of our series on the Rust Belt rebound is next.
Good news today for the Motor City. Detroit is officially emerging out of bankruptcy after Detroit's state-appointed emergency manager implemented a 2-year budget that eliminated $7 billion in debt. Michigan's governor said the nation's biggest ever municipal bankruptcy will come to an end at midnight Eastern time tonight. Detroit's mayor says he's looking forward to better times, but there are still enormous challenges ahead.
From Detroit to another formerly down on its luck city as we continue our special series on America's Rust Belt, which is now in the midst of a rebound. We've shown you how new industries like biotech are picking up where old manufacturing companies left off. But manufacturing is also making a comeback. The big question, though, can it last? Scott Cohn has more from Youngstown, Ohio.
They still call it Black Monday.
The Youngstown Sheet and Tube Company is moving its main office and some of its steel production out of Youngstown, Ohio.
The September day in 1977 when the region's largest employer announced the start of a total shutdown.
If don't steel go, this town is dead.
Youngstown has never recovered, but this may be a start. They're making steel pipe here again, lots of it, to supply fracking operations nearby in Ohio and Pennsylvania. French steel giant Vallourec has already spent $1 billion to expand the Youngstown facility of one U.S. subsidiary.
We bet early on that was going to be a good market, so we built this new $1 million or billion-dollar mill here in Youngstown, Ohio.
Not far away, another Valorex subsidiary is spending $80 million to build a pipe threading plant. Unemployment in the area, which hit a high of 12.7% during the recession, is now well below the national average. But just as Youngstown's comeback gains steam, a potential roadblock. The price of oil is plunging, the economics of fracking changing day by day. And that means the economics of this plant are changing too. Management is watching closely.
It's a very sharp decline, and it's happened in a very short period of time. Right now, it's a little bit too early to tell exactly what's going to happen.
Ohio's governor is trying to take a long view.
I don't worry about falling oil prices when it comes to the shale revolution. I mean, things will come a little bit faster, a little bit slower, but at the end of the day, there's gold in them thar hills.
Youngstown may be on the comeback trail, but it's only gained back about half the jobs it lost during the recession. The fear is that this Rust Belt rebound is just the latest in a long line of false starts. Scott Cohn, Nightly Business Report, Youngstown, Ohio.
To read more about Youngstown, Ohio, and how it's trying to reinvigorate its economy, go to our website, nbr.com. And that is Nightly Business Report for tonight. Thank you so much for joining us. I'm Susie Garrett.
I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody, and we'll hope to see you right back here tomorrow.
Nightly Business Report has been funded in part by
TheStreet.com and Action Alerts Plus, where Jim Cramer and fellow portfolio manager Stephanie Link share their investment strategies, stock picks, and market insights. You can learn more at TheStreet.com/NBR.
I'm Susie Garrett with a Nightly Business Report news brief. A nasty day in the markets today with two big sell-offs, a massive pullback in stocks, which followed another sharp drop in the price of oil after U.S. energy stockpiles grew while global energy demand forecasts shrank. The Dow fell 268 points, the Nasdaq lost 82, its biggest one-day drop in 2 months, and the S&P was down 33 points, with all 10 sectors ending lower. Oil prices fell nearly $3, ending just below $61 a barrel, the lowest since mid-2009. McDonald's will cut 8 items from its menu in an effort to speed up service and increase sales. The city of Detroit officially emerges from bankruptcy tonight. And a new survey says Google is the best company in America to work for. Be sure to tune into Nightly Business Report right here on your public television station.